Adam, thank you for joining me today. You're a good friend to come on. We were talking, sorry, I'm an intro, but obviously I want to talk about 21, 22, what's happening, but thank you for coming to our conference. You're fantastic. And we were talking the other day. I wonder how Adam's predictions ended up the end of this year. So I said, I don't know, let's call him. Let's find out what he's got to say. So this is great timing. Thanks for being available.
That's my pleasure. Thanks for having me, Teague.
All right, so let's go. So I don't know what metrics you're checking, but you're our economist, right? You're sort of speaking of the Hunter Conference, you're our economist, our go-to economist of what's happened. So tell me, how did we end up 21? How compared to all your predictions? And what's 22 going to look like?
Yeah. Well, I mean, this is a great time to kind of look backwards at the year and, see, how did things fare? How did they compare to our forecasts? It's interesting. A year ago, I was taking heat in certain corners for being too optimistic, and went on record about things such as the inevitability of the recovery, and that when we've looked at past crises, we've typically been surprised on the upside. And here we are, nearly at the end of 2021, and performance did indeed beat our predictions for the year. So this will go down, for anyone who's taking recording history of this, that we were not optimistic enough. That said, I think we did get the basic narrative right. So one of the things that I talked about when we were together last was that we would see a strong rebound in the leisure market in the summer months, and that would materialize in substantive form for a number of reasons. We talked about the strength of household balance sheets on the assets side, as well as reduced liabilities. We talked about pent-up demand and kind of the birthright of travel and how that fits into the psyche. And then also the other factor that we have been calling out for a while is that even though we're, as a U.S. market, forfeiting inbound travel internationally, we've also retained would-be outbound travel and converted that to domestic. All of those things made this summer a remarkable summer. Now, of course, there were haves and have-nots across the country, but on the balance, things outperformed our forecast modestly. When I look at it in terms of total trip volumes, this is a forecast we just completed for the U.S. Travel Association. 1 year ago, we were expecting domestic trip volumes to get to 81% of 2019 levels. They came in at 84% of 2019 levels. So we weren't off by a lot, but it turns out we were a bit too conservative as things turned out.
As expected. But I love your optimism. I mean, welcome to the hotel industry, right? I mean, everyone, myself included, but everyone in the hospitality industry, we're all optimists, I feel like. So we were right there behind you, like, oh, this is going to be a lot better than everybody expects. But what other metrics are we tracking?
Yeah. Well, certainly, tracking closely what's going on in the economy right now. And, there are a number of risks, a number of fault lines that are worthy keeping our eyes on. But starting with kind of the baseline situation, I think if a year ago we would say the unemployment rate will be down to 4.2%, we would again have been labeled starry-eyed optimists. But here we are, unemployment at 4.2%. We've recovered all but 3.9 million of the 22 million jobs that were lost in the spring of last year. That's a phenomenal amount of healing in the U.S. economy in a relatively short period of time. We've experienced a classic V-shaped recovery. When we look at GDP, we've already surpassed pre-pandemic levels of GDP. This is nothing like the great financial crisis, where we were looking at a protracted 3-4 years before we saw full healing. So even just to get the levels of economic output, we're looking at a year and a half. We've already crossed through that threshold of where we were pre-pandemic. So there are a number of reasons for that. One of them, of course, is massive amounts of fiscal stimulus that's been pumped into the U.S. economy. But what that's done is continued to position consumers to drive the recovery into 2022, and so when you think about the drivers of hotel demand as well as the driver of the overall U.S. economy, it will be the consumer. That's where we see the greatest strength. for sure. It's why we probably make it through some of the bumps that we're hitting right now without the U.S. economy stalling out. So overall, U.S. economy in a good spot.
We've noticed in the hotel industry, right? The consumer traveler the leisure travelers who's kept the industry afloat. The business traveler is still not there. Group is still not there, although picking up steam. But the consumer works for us too. So let's go. Let's talk about risks, though. What are our headwinds?
I think I've got 4 of them that I've got locked and loaded here. So the first, of course, is the concerns about inflation.
Yeah.
Right. And Oxford's view, my parent company, is that inflation is going to be pretty sticky. That is, we're talking inflation above 3% into 2022, really through the first half of the year before it begins to taper down. And so while that's uncomfortable and is going to require the Fed to act, it is not runaway inflation and it's not stagflation. Right? Stagflation would imply that the U.S. economy begins to contract in the midst of an inflationary environment. There's no signals of that whatsoever. The U.S. economy is continuing to move forward. The concern about runaway inflation, we also think is not one that is going to, it's not going to age well, because the things that are driving inflation, we think, are by nature going to subside as we move into 2022. So that kind of moves us to our second headwind, which is supply chain issues. That's one of the things that is driving inflation costs, and those are, we're seeing signs of that beginning to relent. And whether it's things like microchips for cars, or data on what's going on with shipping, all those things showing signs of resolving as we move into 2022.
Yeah, our containers were $5,000 and now they're $20,000. Is that gonna relent?
Yeah, so shipping costs have begun to come down already. Yep. But they're up over 300%. You're right. From Asia to the U.S., up like 350%. It's insane, and up about 250% from Europe to the East Coast. So yeah, it's obviously driving part of what we're seeing, inflation. But these are things that are they've already leveled off and begun to come down. So I think the concern that, that is a driver continues to push inflation forward is probably not something we're worried about once we get through the next, say, 4 to 6 months. The next concern, of course, would be all the uncertainty related to COVID-19, right? We've got to mention that. That's a fair amount of uncertainty. Right now, as you and I speak, everyone's concerned about the Omicron variant and what effect will that have as far as cases, hospitalizations, and deaths. We stake no claim to being experts as scientists, but one of the things that I've noted that is encouraging as a social scientist is that the relationship between what's happening in that health environment and the way people are behaving are becoming completely untethered. That is that people are becoming less and less concerned regardless of that external environment. And whether that's just, comfortability with risk that begins to come over time, or that is the emboldening that comes with the effectiveness of vaccines that has become pretty clear. People they may be concerned, but they're still traveling. And people are, by and large, I'm seeing this in the data, whether I'm looking at STR weekly data or flight data, what we're seeing in the ebbs and flows of the virus is not getting reflected in the actual travel patterns. And so my concerns in terms of our industry are actually fairly tempered because that relationship has become untethered. People are like, you know what? We're going to live with this risk. Travel's too important, whether it be for business or leisure. Although I think business is more reluctant still. So that would be my third risk headwind. My fourth would be labor force issues, right? And certainly a pronounced challenge for the lodging sector. The job open rate in the latest data is about 10%, which means for every 10 staff positions, there is an open position. So if you have a hotel that's, running with 200 staff positions, that means you've got 20 openings right now.
Yeah, I think it's greater than that, but okay.
Yeah, right. And I think it certainly varies across the country as well. But that is a massive challenge. One of the things that we're seeing as a result of that is wages rise very quickly in the hospitality industry, up some 11% just over the last year. And I don't think we're done with those increases yet as we try to continue to attract more and more staff to fill those open positions.
Yep. And the question in the hotel industry is, can we raise rates fast enough to pay for it, right? To cover all of the rising costs, labor being the main one, but insurance and property taxes.
And I think that's a really important topic. How do rates relate to all of this? And one of the things that I think is, among the list of things that is striking over the last year is how ADR has behaved unlike it has in any other downturn, right? And I'm pretty reluctant to say this has never happened before, but as long as STR has been tracking this has never happened before, which is that rates have fully recovered, yet occupancy has not. It's usually the opposite, right? Usually, rates get cut, occupancy eventually comes back, and then ADR comes back a year and a half later, right? That we're all accustomed to that relationship. Well, here we are, right? I mean, we're still at occupancy off 7-8% relative to 2019, week after week. Rates at or above 2019 levels, week after week. And it's an interesting phenomenon. I think there are a number of reasons for that. One of them you just touched on, Teague, which is that costs are rising. And so revenue managers are, I think, being clear-eyed about the need to sustain rates. Otherwise, they're going to be selling rooms and losing money.
Yep.
Right? So that's one of the reasons. I think another reason is that the software, the basic revenue management platforms are better than they were a decade ago, the last downturn.
We've gotten a lot more sophisticated in what we were doing. And I think we've learned, just because you lower rates, that's not going to increase travel. People aren't going to travel simply because it's cheap. They're going to travel because they're going to need to travel. And if they need to pay it, they're going to pay it. And I think both of those things, along with the technologies mentioned, have allowed us to hold rate. Even if we're running 50% occupancy, it's still full price.
That's right. And I spoke to a group of revenue managers a couple of months ago, and I kind of asked them, I was like, why? You tell me why rates are back. And one of the reasons they described what you just did, and they said, we have a better understanding of price elasticity than we have. And I think this downturn probably put it into sharper relief than other downturns, like where you just realize, like if you're in New York City and a year ago, nobody's coming. And like, I could lower rates for the 10% occupancy, but I think I'd still get 10% occupancy, right? And there's sort of an intuitive situation that I think flowed through decision making as well. But it's been really encouraging, right, to see rates be as solid as they have been.
Just off the cuff, how optimistic are you for 2022?
2022 builds on 2021. I think we continue to move forward. The latest forecast that Tourism Economics and STR released for the U.S. has room demand crossing into the black relative to 2019 in the third quarter of 2022. And so, that behind that is, that leisure, continues to, build slowly on last year's recovery. Leisure is fully recovered in 2022. Business is not. But we do think that business travel comes back especially in the second quarter of 2022. That's probably where we see it strengthening. Certainly, the Delta, if you look before the Delta wave, kind of in the summer of 2021, businesses were really gearing up to hit the road.
Yes.
And Delta stalled that out a bit, right, in the early fall. And I think Omicron's going to stall out again. But our expectation, as far as our baseline, what we think is most likely, is that by the second quarter, you've got businesses operating pretty much, at normal levels of travel. When I look at group data, bookings for future events, it looks like we're going to be off next year in the range of 15 to 20% in room demand on the group side. So that's going to be real slow to come back. We're talking a couple of years for the group market to come back. It took a few years to come back after the great financial crisis, I should mention. So I think we can be patient, not feeling like, oh no, we've got some existential, situation here for groups again. So we'll come back, but it's going to be several years.
You think it's the same? We're having the same amount of group travel, same amount of meetings, just fewer attendees, or have we lost some of the events as well?
Yeah, I think next year the story is going to be primarily about fewer attendees. It's going to be a mix. Sure. It's going to be a mix. And I look at what's on the books itself, about 15% right now. There'll be more meetings that are booked. But attendance, and I've been attending a lot of conferences over the last 6 months, and I would usually ask the organizer, how's attendance relative to pre-pandemic? And I'm getting pretty consistent responses that, they're off 20, 25% now, right? So there's no reason to think that's going to completely level up in 1 year. I think there's upside potential as well, I should mention. Looking at over 10% in a recent survey of travelers saying that they are going to be working remotely for part of the year. So that's travel, right? And it could be travel for multiple reasons. It's travel because I want to work somewhere nice, but then it could also then be travel because I got to get back and meet with my team for these key meetings, right? And so there's this whole new potential market that could emerge over time, which is with more adoption of remote learning. What does that generate? Not only in terms of leisure travel, but in terms of business travel, where previously, we're all in the office all the time. We don't travel to do that. But if now I'm stationed for part of the year in Southern Florida, but I got to get back for meetings. Now I'm generating new business travel that otherwise didn't exist.
I like to hear you use, we all should go to Southern Florida. I'm obviously a believer in travel. I'm glad to hear you're a believer in travel too. The people are going to come back and get back together. So that keeps me optimistic. I'm curious though, on your thoughts. Talk to me about interest rates. Where are they going next year?
I think it's very likely the Fed does increase interest rates. I think that they hold off for a bit, though, with the amount of uncertainty regarding Omicron. And keep in mind, the Fed has at its disposal the tool of first tapering down bond purchases, right? So that's going to be that's front and center. That's going to happen, imminently, right? And so I think the Fed wants to see how does that play out. So I think we're well into 2022 before we see the first interest rate hike. So we as Oxford are probably on the more I'll say conservative side, and we don't think the Fed is going to aggressively raise interest rates. We think it's going to be very slow. We think it's going to be the latter part of 2022.
Okay, which should help again in our industry when you're borrowing 70% of your asset value. Interest rates matter, right? Debt matters, et cetera. So I think we're all watching that fairly closely. Some of it we can handle. I think it's built in, but my concern is if it goes up too quickly. So maybe that's 23 when they push it off too long, and then 23 it skyrockets. Which right now that says to me that 22 will be a robust transaction year. Everybody trying to get ahead of that, and maybe stealing 2023 transaction business, bringing it into 22, getting it done. But I don't know. I digress. All right, give me some final thoughts on what else we should be looking for next year. Give me the key points.
Well, I think one of the key things next year is going to be, the return of cities. I mean, cities have been, the top 25 markets, if you take Miami out as an outlier, have been just incredibly hard hit, right? And they've been hard hit because they've been most exposed to business travel, to group travel, and to international travel, right? And because travelers who are traveling for leisure have been primarily seeking outdoor experiences, a lot of the main attractions, museums, shows and the like have been closed anyway. So that has just put, an unbelievable strain on these markets. I think 2022 is the year where we see, the renaissance of cities again.
So I do want to know, where are you traveling? Where's Adam Sachs traveling next year? 2022. Where's Adam Sachs traveling?
Yeah. Well, we have our family New York City trip already planned for New Year's Day. So this is called helping to fulfill your own predictions about cities coming back. But yeah, so we do have a trip as a family for spring break planned to Florida. We do a beach trip as a family every year. We rent a house on the eastern beaches here in Delaware as well. So those are our kind of tried and true family vacations. We'll visit family in Texas as well. So I'm in the Northeast, but my wife's family is in Texas. So we'll be there at least a couple of times. And then I'm hoping to take my son to Coachella Valley for the BNP Paribas tennis tournament. I've got an in to attend that.
Tennis family? Is that what I just heard there?
Yeah, well, that's
player in the family.
That was it was my sport, and my youngest son is he's a player.
Okay, all right, fantastic. How about final question? Then I'm wrapping up. Although to conclude, you're traveling to cities and leisure, and then you'll travel to major cities for business. And I did not hear international in there anywhere. All right, final question. Right. How's the garage band that Adam Sachs started? I see the guitar in the back. Are we still strumming tunes for the hotel industry?
We're still creating hopefully enjoyable content, rewriting songs, and just trying to add some balance to the left-right brain situation on a daily basis.
I love it. You got to send over some new riffs, whatever your new songs are. We got to hear them.
All right, I've got one on the importance of meeting face to face that I'll share after this.
That's the one we want. All right, Adam, you're a good man and a true friend. Thanks for joining me. I appreciate the year-end wrap-up. We always love hearing it. And I'll see you in March.
Awesome. Looking forward to it. Thank you, Teague.
Thanks, Adam.